Welcome everyone to another industry and transition Zoom call. Matter of fact, our first one for 2021. We're putting the dumpster fire of 2020 in our rear view, and who better to do that with than Ron Kruszewski. Thanks for being here, Ron.
Absolutely. Thanks for having me, Tony, and Happy New Year to you.
Happy New Year to you. So, I mean, this is, we saw you, I saw you, you've been doing some Zoom stuff. Well, you were at our event in November, which was pretty good, sort of an overview of where things might be going. So we appreciated that. And you have another event I saw that you're doing in February as well. What's that about?
We do. It's on February 10th. It's a 60-minute advisor open house. We
Nice.
we hear from advisors all the time that come here that our open houses, when people come to a Stifel, they really get a sense of what's going on here. And so we're going to have a virtual event. It's going to be a great event. Maybe I'll have you say a couple words, Tony.
I'd love to do that. So one question about that, this may be beyond your pay grade, but if I'm at another firm and I attend that thing, am I anonymous? Can I come there without anybody knowing, or is my manager going to call me and say,
Oh, yeah, absolutely anonymous. So we did think of that, Tony.
Well, I like to keep you on your toes a little bit.
Yeah, for sure.
So we did have this dumpster fire last year. I want to hear a little bit about how you guys handle it, because we haven't, we talked in general about it, but we haven't really sat down and asked the questions. A lot happened. There's a lot that I think we're going to take away from 2020, and there's a lot we'd be happy to leave behind. Just a little bit, how do you think you guys fared?
If you would have told me in March during the beginning of this pandemic that we would end the year with a record year across the board, and client service levels that were as high as they were, which was very good here, I would have obviously been a little skeptical that would have happened. But I will tell you that we're pleased, and we've learned a lot in the last year. It was a dumpster fire in many ways, but I think the industry's learned a lot. We certainly have learned a lot here at Stifel.
Yeah, I think interestingly, our industry actually did fairly well. And considering that we were, dead center, right in the middle of this thing, and you and I both know you're the longest serving CEO, right, in the industry right now. But had this happened 10 years ago or 15 years ago, different story. We didn't have Zoom. I don't know how we would have handled it, but it would have been trouble.
Yeah, the technology investments that we have made certainly helped us service our clients. So that's one of the things that we need to take away from that. But I'll tell you something else, Tony. The other thing that we learned is that Zoom is not the end all. All right, it's not. I believe that human interaction is important. Many of our offices have stayed open during the pandemic. We didn't have a global, every office has to be closed. We left it to the local managers and the circumstances in local communities. And what I have learned for sure is that it's important to have physical locations. So you're not going to hear me saying, "Oh, we don't need branch offices anymore."
Right. Well, and I think a lot of our industry, we are looking at real estate. What this interesting you mentioned about Zoom, because I'm putting together my predictions, for 21. And one of the things, is Zoom poisoning, that we've got almost too much Zoom. We're getting over Zoom. I'm sure you have 1,000 of these a day. I have 1,000 of them a day. They're counterproductive at some point because you're missing a lot of the interactions that you need, just to think, just put stuff together.
Well, I would say it's because we're actually not in a setting where we have a free exchange of ideas. That happens not really on Zoom. That happens when you're actually together. But, we'll get through this pandemic. The one thing that we've seen that we're using Zoom from an advisor perspective is that it allows us to be the quarterback. So we can have a meeting in our office, in our conference room, and then we loop in the tax guy, we loop in the lawyer, we loop in some of on Zoom, but we're sitting there as the quarterback of the meeting. And look, that's what I think is going to be an advantage for advisors in the future.
Well, interesting advantage for advisors in a larger firm that has access to that stuff, right? Because you have to actually have that. And that's part of the issue when you're sitting alone as an RIA. You don't necessarily have access to all those people.
Yeah, well, I can tell you one thing: we're making big investments in technology, so for sure.
And you look at also how we're going to service clients in the future. There's it may have been that clients, would be insulted if you wanted to do a phone conversation with them rather than come visit them or a handshake. But now I think this stuff is accepted, this Zoom. And especially if you do what you just said, which is very interesting to me. Let's loop in the attorney, let's loop in, the tax and let's talk about some estate plan. I mean, that's an impactful Zoom call. So I think that's one of the things we're going to.
Tony, I think some clients get insulted though if you don't answer a Zoom call at 11 o'clock at night. I mean, that's the other thing that's changing a little bit here is that, the traditional workday has certainly been expanded. But again, as I look forward and as I think what's important in the coming year, not only 2021, but the future, is that we provide clients access to all the products. That's what we do at Stifel. We want access to the best investment ideas and service meaning how the client wants to be serviced, and that can sometimes be through Zoom, sometimes it's in person. We have, and the industry needs to service clients as they want to be serviced.
Well, and that's part of my Zoom poisoning idea here is that clients, once they have access, you can't go backwards with that stuff. You can't suddenly service them less going forward. So if they're used to calling you now during Zoom at 7 o'clock at night while you're making dinner, they're still going to be doing that.
Oh, for sure. And look, you had your event in November. I thought it was very well done. We had our blueprint of that. But these virtual events, I'll take when I came to New York and saw you, and then after the event, we were able to talk and see a lot of people. Certainly at Stifel, when we have our national meeting, the one in person certainly was a lot better than the virtual one.
Yeah, it's going to be a hybrid world, I think, Ron, going forward. There's some things that are so great about having this kind of access and intimacy, and even for the readers of AdvisorHub to be able to hear from you in this way. I mean, this is a great thing. But nothing will have to come back to handshakes and being able to meet face to face.
Well, look, this is an advanced telephone call. Okay, so you used to pick up the phone, you and I would talk. It's just an advanced telephone call. So if I would believe that advisors that recognize the human interaction, the importance of that, are the ones that are going to gain clients. Advisors that solely rely on Zoom, I think, are at risk.
I agree. And
it's my opinion.
Well, the other group of advisors, and you and I have talked about this before, that may be at risk. Look, this was the year ended up, okay, right? Especially, financial markets and things like that. But it didn't look like that in the beginning, right? And there were some times when it was pretty scary. So the advisors that did passive investing, again, I'm looking for your opinion on this. You kind of know where I stand on it. How much value are those guys adding? And then where are they in terms of at risk with losing their clients?
Well, two things. Asset allocation is becoming, in terms of just using ETFs, I've always thought that would run its course. It's goals-based planning, and it's tailoring individual situations. And clients like stocks and bonds and individual stocks and ideas. And this year, our advisors that use a broad base of products, but also individual stocks, significantly outperform those that were just using the packaged products.
Yeah, no question about it. I mean, and that seems to be the other positive here is that advice is something that's not going away. I mean, there's robo stuff, we seem to have done better against the robos, during a crisis, which doesn't surprise me. Maybe, I don't know how you feel about it.
Well, hey, advice has been going away since May 1st, 1975, when you could have it. And I've been my 25 years as CEO, or almost 25 years, I've heard constantly that the advice model is at risk, and au contraire, it's not at risk. It's not going to be a risk in the future.
So interestingly, the future includes millennials, which is a group that we're not doing so well with. Let's put it this way: traditionally, we've not done well with. I think prior to the pandemic, I don't know if you know the statistic, but the amount of growth that our business had with millennials, like adding new clients, but 0%. So there was like no growth in the past couple of years. 0% right? How does that happen? My feeling is that the Zoom stuff, I think they're comfortable in this world. And, I think they looked at a market that they thought was easy, right? Because for 10 years, all you had to do was put money in the stock market and you made money. So maybe this combination of a volatile market and now advisors advancing with technology, that might help us with millennials.
We've always millennials. I used to be the equivalent of millennial, right? I'm not
Oh,
anymore.
word.
I just had a birthday, but I will say that look, when you're young and you're just get married, you're not putting as much money as you'd like to into investments. You're putting it into your kids, into the school, into homes, and so generally the millennials are, they mature into investing clients as their kids get older. I'm talking on average here, so we'll be fine with millennials. I have 4 kids. They all were do-it-yourself investors until they had kids, and they don't have time. And now they all have advisors that help them achieve their goals.
Well, interesting. Another point about millennials and sort of the tough year that we've had is, as look, my feeling is, and I know you feel the same way. I almost don't have to ask this, but you learn so much by being in an office environment. And when you're young, you need a mentor. You need somebody, because you don't know what the heck you're doing. You want to go on meetings with people. You want to sit down and hear somebody talk to you. How tough has it been in our business to get new people in it? I'm talking about for anyone. Your kids, my kids are sort of the same age, right? It's hard. They're working from home. They're not going to an office. They don't understand what's happening on a day-to-day basis. It's like we.
Well, I think it's first of all, these are all our kids. Okay, I don't even like using the word millennial myself. I'm just talking about people that are getting into our business. There's no question that what you learn in it, we are a on-the-job training business. Okay, we learn from each other, and we learn from being together, and that's really not going to change. And again, as we get through the pandemic, we will bring people back, and we'll move on to the next challenge.
Millennials are also smaller accounts, right? So if you do get to open them, they're going to be smaller accounts based on just all the things that you said. A lot of the big firms, the wirehouses, aren't letting advisors open accounts. And in my mind, that has a whole bunch of implications that are all negative, right? So it really takes away the entrepreneurship of a young person. Say I'm the first generation that's gone to college, right? Or I'm a minority or a woman and I don't have these maybe access to the same groups. You start off small. All the accounts I opened when I started, back at Merrill Lynch were $10,000. And by the way, they were all dentists because my dad was a dentist. So it was a whole bunch of dentists. But I was able to do that. You know what I mean? I was able to open small accounts. And that's another reason maybe we're ignoring millennials at different firms. Where do you guys come down on that?
Well, we don't have account minimums. We leave it to our advisors to decide. I always say that if I look back 10 years ago, a number of accounts that were below some of the large wirehouse minimums. So if you didn't have $250,000, you can't, you have to be sent to a call center. I find that to be a ridiculous line in the sand, because when I look back 10 years, the number of large accounts today that 10 years ago would not have met that line in the sand, it's incredible to me. So I often think that a lot of this segmenting of accounts is more done by the management of large firms, which are truly trying to separate the business from advisors into more less advisor centric.
There's no question in my mind that's not only the result, that's also things that started out maybe as good ideas like teaming are turning out to be another way to sort of put a wedge between a large advisor and sadly between an entrepreneur and his or her business. I mean that's the great thing that started our whole culture.
Yeah, but it's not sadly because it's only sadly if you're in an environment that's having you do that. But the good news is that place like Stifel, it isn't that way at all. If you're entrepreneurial, come on over. Okay, you're going to love it here.
I was hoping you were going to see that as an opportunity, but well, you got to sell. So, but my thing is this European. I call this the European broker model. I look at it as a genuine threat to people that are there. The more you get locked in, you sign these big 9-year deals. They start changing the comp plan on you every 2 minutes. That's another thing. Comp plans constantly get these guys getting whacked left and right, and you have sort of no control over it. You do have no control over it.
Tony, you keep giving me softballs here, okay? You talk comp plans, okay? As I said, I've been CEO since '97, and I'll tell all the advisors out there, since 1997, we've changed our comp plan exactly 2 times. Okay, and they were very simple changes, and we didn't change it this year. I again feel that what we recognize as the value is the entrepreneurial advisor. That's what we're looking for, and we're doing everything we can to allow them to be entrepreneurial, because entrepreneurial advisors do better by their clients. Period. That's
yeah,
my.
I couldn't agree more. And it's also just good for the country. It's good for so many, so many different things. And you look at where the future is going. People are moving. There's an RIA model that sort of embraces, an entrepreneurial spirit, and then you have the wirehouse model, as we said, that seems to be embracing a different ethos. Let's just categorize it as move towards a European centric, kind of model if they can get there, limiting your accounts and all that kind of thing. And then you have the Stifels of the world. You're sort of embracing. You have a lot of the attributes of a wirehouse, but at the same time, it seems like you have the ethos of the RIA, which is.
I just define Stifel as advisor heaven. Okay, so that's when if you ever go up and you think you're at St. Peter's, you'll see a sign that says advisor heaven and it says Stifel under it. So that's how we look at it. Again, you have the best of both worlds. We have a bank, we have brokerage relationships. You can buy raw securities, and you can have fee-based accounts. So you can do all of that.
You own the bank. That's the difference. So you own the bank, and the bank's not telling you got to sell so many mortgages or you're going to be, you're not going to be allowed to open this account, that account. That's a pain in the ass.
Again, we provide products and access for our advisors. Our advisors decide what is in their client's best interest, and they execute. So it's a business model that I'm very bullish on as I look forward to 2021 and beyond.
So before I want to move on to, I know just a political and tax thing, next, but I do want to circle back to the real estate stuff. I understand you want to have these offices. We're going to continue to have them. Do you see any changes? For instance, when I talk to advisors, I don't think anybody thinks that we don't need any offices, but you see like a lot of RIAs saying, I spent all this money on this, ego barn, and I don't need it anymore. I'm doing a lot of Zoom work. So I'm going to have like kind of I'm going to scale it back, have a meeting room with some, I'm wondering, are you thinking in a similar vein? Because real estate's an expense too, as a firm. Just, is there an acceptance among a guy like you to maybe make some changes there if you needed to?
Yeah, look, I think that markets always evolve and technology evolves, and we will evolve with it. I just believe that it feels just really simple to say, hey, we can cut all this real estate expense and we'll just give everyone an iPad and tell them to do everything on Zoom. And I do not believe that is in the best interest of our clients, right? It might be in the best interest of my bottom line in the short run, but in the best interest of our clients, I think we need to have physical locations where people can collaborate. And that's not going to change. That changed during the pandemic, but human nature hasn't changed in the last 9 months. I can assure you of that.
Right. Well, we're having this discussion today. Georgia is voting. It's gonna sort of tell us what's going to happen in the Senate. There's a lot of implications in terms of policy, taxes, things like that. I'm wondering where you're at on that this morning.
Well, I love it. So here you are, you're asking me a question on Tuesday, and it is January 5th, and I'm sure this isn't going to be, you're not going to broadcast this until after the elections are over. So I'm going to be very careful to anything I say to make predictions. But I will start with this. Whatever happens in election, though, isn't really going to impact the regulatory front on our business. All right. We're going to have a new head of the SEC. We're going to have some changes in Reg BI. The DOL is going to make some changes. All of these things are things that the industry will deal with. I think we'll deal with effectively, but Georgia is not going to impact the regulatory side of this business. Right. What the Georgia elections are important, and I don't want to get into all of the agenda items of the Democratic Party, what I will focus on are things that I believe impact the cost of capital for our business and investors need to be mindful of. And that's mostly on the tax front, okay, and increasing capital gains and increasing some of the things that I have seen on the state taxes. These are in many ways increasing the cost of capital of our business and to investors. And so I'm certainly somewhat concerned about that. And I think the Georgia elections will determine whether or not these things happen.
Yeah, we'll have an opportunity, I think, after this is over to talk about what the implications may be. I mean, certainly people are calling for, more volatile markets, coming up. I know as far as taxes go, I've been paying them. I've never gotten a thank you note from anybody for the taxes that I've paid. I'm still waiting for somebody to say, hey, thanks, right? But let's penalize the most productive citizens. All right, I'll get off of that. What was I going to tell you? I said the other thing I was going to ask you about.
I don't know.
I was on a roll there, and then I got aggravated with the taxes, and then I can't remember what my last.
Well, again, I think we just these are interesting times in terms of zero interest rates and all of that. I would tell advisors that we need to be thoughtful and mindful of the environment that we're in. I, for one, believe that the rate environment we're in is not going to be around for the next 5 years. And I believe we're going to see an increase in rates. I think we're going to see an increase in inflation. And I think these are the things where good advisors are going to be looking forward and looking at what can change on the investment horizon and help their clients navigate those times.
I think, as we said before, this increased volatility that we kind of expect will separate the good advisors from the bad, yet again.
Always has and always will.
Great. Well, we're about 20 something minutes in here already, Ron. So I like to give people a break. They want more of us. Leave them wanting more. So anything else that you didn't get to say that you want to say before we sign off?
I first of all, I appreciate you having me on. I appreciate being one of your first guests of 2021. I have been doing this a long time, and I think as much as things change, they stay the same. All right. And the same is the value of advice, the value of understanding an investor's or a client's, personal goals and aspirations and helping them achieve that. And that hasn't changed in the last 25 years, and I don't think is going to change for the next 25 years. I'm very bullish on our business. And I'm excited to continue these conversations with you and look forward to having an update with you. So to everyone out there, let me just say Happy New Year and let's have a great 2021.
Thanks, Ron. Appreciate it.
You got it.